You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Microeconomics 101, Supply, Demand, and Convertibles, written on 8th of October 1992. Let's dive into the timeless insights that continue to influence investors today. Hey everyone, ready to dive into some serious investment strategy? Today's deep dive, we're hanging out with the one and only Howard Marks.
The man, the myth, the investing legend.
We're cracking open a memo he wrote back in 92, yeah, you heard that right, 1992, called Microeconomics 101, Supply, Demand, and Convertibles.
Talk about vintage, Marks. This memo shows how he was applying classic economic principles to the stock market way back then. And get this, his insights are still incredibly relevant today.
Okay, so we're not talking about like finding rare beanie babies in your attic. What's the core concept Marks is getting at here?
He's really breaking down the dynamics of supply and demand, but through an investor's lens. Marks argues that most investors get so fixated on an asset's perceived quality, like its brand name or past performance.
They're blinded by the shiny object.
Exactly. They miss the bigger picture, the price you pay. Marks would say that even the best company, the most promising business, can be a terrible investment if you overpay.
It's like going to an auction and everyone's fighting over a Mona Lisa print, completely ignoring the actual Rembrandt in the corner because they don't recognize its value.
A perfect analogy, and that's where Marks drops his now famous line, everything is AAA at the right price.
Whoa, okay. That sounds kind of dangerous taken out of context. Is Marks really saying we should just buy up failing companies as long as they're cheap?
Not exactly. It's about understanding intrinsic value. It's like imagine a house that needs a little work, maybe some fresh paint, some landscaping. If you can buy that house way below market value because others are scared off by those cosmetic fixes, that's a AAA opportunity, right? You're getting the underlying value at a steal.
So it's less about chasing what's hot and more about finding those undervalued gems.
Exactly. Marx would say it's about being a discerning shopper, whether you're at a flea market or on Wall Street. Now, remember, in 1992, the U.S. was just coming out of a recession, so there was a lot of uncertainty in the markets.
So investors were a bit jumpy, maybe not seeing the forest for the trees.
Right. And that's where Marx swoops in with his contrarian thinking. He's saying, don't just follow the herd. Look for opportunities where fear has created mispriced assets.
Be greedy when others are fearful. Got it. Now, Marks uses convertible securities as a prime example in this memo. For anyone who hasn't memorized their Wall Street dictionary, can you remind us what those are again?
Sure. Convertible securities, they're like the hybrid car of the investment world.
Okay, I like where this is going.
They offer you the stability of a bond with the potential upside of a stock, so you get the regular income from the bond's interest payments.
Which can really help you sleep at night.
Exactly. But then you also have the option to convert that bond into company stock if, and this is key, if the company does well. So it's like having your cake and eating it too, to some extent.
So why was Marks so bullish on convertibles back in 92? Was it just their cool hybrid nature?
It was more about the economic climate and understanding how supply and demand were playing out. See, the convertible market was recovering from a bit of downturn. Investors were a little hesitant to jump back in.
Makes sense. They were still a little spooked.
Yeah, and that lack of interest, that hesitancy, meant that convertibles were trading at a discount. Marks saw this low demand as a contrarian indicator, a sign that these securities were undervalued.
So less demand, lower prices.
Yeah.
It sounds like an opportunity brewing.
Exactly. And to support his point, Marks even pointed to data from Barron's. They reported that assets in convertible funds were significantly lower compared to just a few years earlier.
So the data was backing up his hunch.
It was. And this, my friend, is a key takeaway for investors today. When everyone is piling into the same asset class, whether it's tech stocks or real estate or whatever the hot new thing is, it often means prices are inflated and the smart money is looking elsewhere. Marks would tell you to look for those overlooked opportunities, the places where other investors aren't paying attention. That's where you're more likely to find those AAA deals.
This is already making me rethink my whole portfolio. Marks was really advocating for a contrarian approach, wasn't he? Doing your homework, thinking for yourself, and not being afraid to go against the grain.
Absolutely. He believed that the real gems, the hidden treasures, are rarely found by following the crowd. And that contrarian thinking, it applies even when we're talking about the opposite scenario, when demand for an asset gets too high.
Okay, so we've talked about the potential upside of low demand, but what about when things get a little too popular? I'm guessing that's where things can get risky. Okay, so we've talked about the potential upside of low demand, but what about when things get a little too popular? I'm guessing that's where things can get risky.
You hit the nail on the head. Marx argues that when too much capital floods into a particular asset, it can create a recipe for disaster. And he uses some pretty vivid examples to prove his point, like real estate and leveraged buyouts, or LBOs in the 1980s.
Ah, the 80s, big hair, shoulder pads, and even bigger financial risks.
Exactly. But as Marx points out, that whole era, especially in those markets, it was all driven by this, well, frenzy, this almost irrational exuberance. Everyone wanted a piece of the action, which drove up demand and, of course, prices to unsustainable levels. It was like a bubble just waiting to burst.
And burst it did, leaving a lot of investors wondering what hit them.
Exactly. And this is where Marx's philosophy gets really interesting. It's not just about being contrarian for the sake of being different. He's saying that understanding the psychology of the market, those emotional undercurrents, is just as important as understanding the fundamentals of a business. When everyone's feeling euphoric and piling into the same asset, that's usually a sign that it's overvalued, that the music is about to stop, so to speak.
Like a game of musical chairs, but with a lot more at stake than just a seat.
Precisely. And when the music stops, you don't want to be the one left standing without a chair, or in this case, a valuable asset.
So how can investors avoid getting caught up in that hype, those emotional decisions, especially when it seems like everyone else is getting rich quick?
The million-dollar question. It takes discipline, for one, and independent thinking. Don't just blindly follow the headlines or what some talking head on TV is saying. Marx would say you need to develop your own investment thesis, your own framework for evaluating opportunities.
So don't just chase the hype, do your homework.
Exactly. Remember those convertible securities we were talking about earlier? Marx saw their low demand as a buying opportunity, but that's because he had done his research. He understood the underlying fundamentals of that market. He wasn't just chasing a low price for the sake of it.
So it's not just about spotting what looks like a bargain on the surface. It's about understanding why that bargain exists.
100%. Is it a genuine opportunity, or are there underlying reasons why everyone else is staying away? Those are the questions you got to ask.
This is making me feel like a much more discerning investor already, even if I'm just managing my own little portfolio. But how does this all tie back into that whole everything is AAA at the right price idea? Is Marx really saying any investment can be a good one?
He's saying that an asset's intrinsic value is paramount. Now, a AAA rating, traditionally that refers to a bond's creditworthiness, right? But Marx uses it more metaphorically to describe any asset, a stock, a bond, even real estate that's undervalued by the market.
So it's not about blindly buying anything that seems cheap. It's about understanding the true value of an asset and being patient enough to wait for the right opportunity.
You got it. Patience is key. And Marx is a big believer in understanding those big overarching market cycles, those swings between greed and fear, overvaluation and undervaluation. He'd say that successful investors don't try to fight those cycles, they learn to ride them.
Like surfing, wait for the perfect wave, and then ride it.
Exactly. Know when to paddle out, when to catch the wave, and crucially, when to ride it all the way to shore. Because jumping in at the peak, when everyone else is already riding high, that's a recipe for getting wiped out.
This deep dive is really driving home the importance of understanding that bigger picture, isn't it? The economic landscape, market psychology, those underlying cycles that influence asset prices. It's not just about picking individual stocks. It's about understanding those bigger forces at play.
100%. And that's what makes Marx such a brilliant investor. He sees those connections, those subtle patterns that others miss. He's always thinking a few steps ahead, anticipating those market shifts and positioning himself accordingly. But what I find so fascinating about his approach is that it's not just about crunching numbers. There's a deeper philosophical foundation to his thinking.
Oh, I love it when we get philosophical. So what are some of those bedrock principles that guide Marx's approach?
Well, at its core, Marx's philosophy is rooted in value investing.
Which essentially means, just so we're all on the same page.
Right, so value investing is about finding those assets that are trading for less than their intrinsic worth. It's like finding a rare antique at a flea market for a steal. You recognize its true value, even if everyone else is overlooking it.
Love that analogy. Okay, so value investing is key. What else?
Well, Marx is also a huge advocate for contrarianism.
Which, in the investing world, means?
It means having the conviction to go against the grain. to zig when everyone else is zagging, as long as you've done your research, of course.
Right, not just being different for the sake of it.
Exactly. He firmly believes that the greatest opportunities often present themselves where others aren't looking. And that requires independent thinking, a healthy dose of skepticism, and the courage to trust your own judgment, even when it goes against the crowd.
So it sounds like Mark's approach to investing is as much about understanding human behavior as it is about analyzing financial statements,
Yeah.
which is fascinating, right? Because at the end of the day, markets are driven by people.
Absolutely. Emotions play a huge role. But okay, we've thrown a lot of ideas out there. Let's bring it back down to earth a bit. What are some practical, actionable insights that investors can take away from all of this? How can we apply these principles in the real world?
Yeah, give us those golden nuggets of wisdom, those actionable insights. Where do we even begin?
Well, first things first, and this might sound obvious, but tune out the noise. Don't get swept up in every hot stock tip or market trend you hear about. Just because everyone's raving about something doesn't mean it's right for you or that it's even a sound investment in the first place.
It's like those infomercials. They make everything sound amazing.
Exactly. So before you hit that buy button, take a step back. Do your homework. Understand what the asset is actually worth, what its intrinsic value is, not just the price tag it's currently carrying. Remember that house that needs a little TLC?
Our AAA fixer-upper.
Right. It's only a bargain if it's based on that real underlying value, not just because it's cheap.
So channel our inner detective. Got it. Now, what about Marx's love for contrarian investing? How can we apply that without, accidentally buying into the next, let's say, Betamax?
That's where understanding market cycles really comes in handy. Marx is a big believer in, well, he argues that markets are constantly swinging back and forth.
Like a pendulum.
Exactly. Between fear and greed, between bubbles and crashes. It's those emotional extremes that drive those swings. So instead of getting caught up in the frenzy, you got to learn to recognize those patterns. When everyone is panicking, running for the exits, that's often a good time to look for undervalued assets. On the flip side, when the market's euphoric, everyone's popping champagne, prices are sky high, that might be a good time to.
Take some profits.
Exactly. Take some chips off the table. Don't get greedy when everyone else is.
Easier said than done sometimes. But I hear you.
Oh, absolutely. It takes discipline. And remember, Marx isn't saying you have to buy everything that's cheap or avoid popular investments entirely. It's about being savvy, about understanding what's really driving those prices.
Those fundamentals and those oh-so-human emotions.
Exactly. Fear and greed, they can cloud anyone's judgment.
Well, this has been an incredible deep dive. Who knew a memo from 1992 could be so relevant today?
Right. Marx was really ahead of his time.
He really was. Okay, so as we wrap up here, any final words of wisdom from the legend himself that we can leave our listeners with?
Well, Marx would probably tell us to remember his famous line, the one we keep coming back to. Everything is AAA at the right price.
Words to live by, investors.
Absolutely. Do your homework, trust your gut, and don't be afraid to chart your own course.
That's a wrap on today's deep dive into the brilliant mind of Howard Marks. Until next time, keep exploring, keep learning, and keep diving deep.